Welcome back, everyone. This is a brief update on the oil market. In the previous days, OPEC confirmed through its report it had cut oil production sharply under a global supply deal, but at the same time made reference to circumstances that could affect its current course taking place to prevent excess supply this year. The oil group stated potential threats coming from weaker demand and higher rival output, indirectly indicating the US production could affect supplies in the next months. We must note the biggest drop in production was brought forward by leader producer Saudi Arabia, which amounted to 350,000 barrels per day, the report showed. The group also added that it expects demand for its crude to decline to 30.59 million barrels per day, implying a reduction of approximately 240,000 barrels per day compared to its previous report. Furthermore, Saudi Arabia and Russia have seemingly cancelled the plan they had in mind from prior years to form a group of their own. The idea was publicized since 2017 when the two oil giant producers agreed to cut production and help balance the oil market. The decision to scrap the plan may have come after the latest US anti-cartel legislation for oil industry, a report stated. But our opinion is that the plan may be formed secretly and not on paper as previously thought to be. In any case, the OPEC Plus group oil supply may be exceeding global market demand with the revised statistics indication. Reports from the US estimated crude output to increase by 1.45 million barrels per day this year and 790,000 barrels per day more in the next year, totaling an output of 13.2 million barrels per day according to the Energy Information Administration. US oil production this year is forecasted to be at a record of 12.41 million barrels per day, the EIA said. The report cited as a reason the ongoing progress and development of the Permian Basin of Texas and New Mexico and the output in the Gulf of Mexico. If they can produce at lower prices, they will most probably be able to provide better deals to potential customers along with cheaper prices. On another front, Venezuela's oil market does not seem to be in a stable situation at all after the new US sanctions came to effect on January 28th. According to Reuters, state-run oil company PDVSA is attempting to replace oil supply to the United States and Europe that were disrupted by payment restrictions by selling to India, a huge oil-consuming country. The Latin American country is said to be aiming to increase its oil business with India as it already provides the Asian country with fuel, with the difference that the payment will be made in cash. As a conclusion, we would like to note comments from EIEA's Fatih Birol that referred to the upcoming development of the US shale production, saying the US could be very responsive to oil activities this year, but also to keep in mind that a new under-construction oil pipeline system will open in a later stage that could hold more capacity and could even be more responsive to demand and production. And so traditional oil producers may need to adapt or look out in the future months. For more information and trading ideas, you can visit our webpage, follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+. This is Angelo Zittis from IronFX, wishing you solid trading.